WeWork Companies Incorporated filed for Chapter 11 bankruptcy protection on November 6, 2023, listing liabilities of approximately $18.7 billion against assets of approximately $15 billion. The filing was the conclusion of a trajectory that had begun 4 years earlier, when SoftBank's Vision Fund had valued the company at $47 billion in January 2019. And WeWork had been preparing for what its management described as one of the most consequential initial public offerings in the history of American technology. Between January 2019 and November 2023, the company's valuation declined from $47 billion to approximately $45 million at the time of the bankruptcy filing, a destruction of approximately $46.955 billion in implied equity value that no previous case file in this channel's archive has approached in speed or in the ratio of peak to trough. The forensic entry point for this case is not the financial collapse itself, which has been documented in enough detail to constitute a small library of business journalism and academic analysis. The forensic entry point is the lease portfolio, because WeWork's bankruptcy was not primarily caused by the failure of a capital structure placed on a physical asset. It was caused by the failure of a capital structure that had been built on top of a portfolio of lease obligations. The long-term commitments to pay rent on office space across the world that WeWork had signed at peak market rates during the years of its expansion, and that remained fully enforceable against a company whose revenue had declined to a fraction of what those obligations required. WeWork's business model was architecturally simple and financially complex. Sign long-term leases on office buildings at institutional tenant rates, subdivide the space into short-term memberships for individuals and companies who needed flexible office access, and capture the spread between the long-term lease cost and the short-term membership revenue. The model required the membership revenue to consistently exceed the lease cost plus the operating cost of the shared workspace infrastructure. When the revenue declined, the lease obligations remained. When the leases remained, the company could not restructure its cost base without the cooperation of landlords whose own financial positions made negotiated lease terminations and rent reductions difficult to achieve at the scale that WeWork's cost structure required. The building was not the subject of WeWork's bankruptcy. The building was the instrument of it. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. WeWork's lease portfolio at the peak of its expansion in 2019 included approximately 13 million square feet of office space across approximately 760 locations in 123 cities across 33 countries. The aggregate commitment of those leases represented long-term payment obligations totaling approximately $47 billion, a figure that was not coincidentally close to the $47 billion peak valuation that SoftBank had assigned to the company, because the valuation had been constructed on the premise that the revenue the memberships would generate from those spaces would exceed the lease obligations by a margin sufficient to justify the equity premium that technology company valuations commanded in 2019. The covenant that nobody at SoftBank, at JP Morgan Chase, or at the institutional investors who participated in WeWork's fundraising rounds read carefully enough was the one embedded in the asymmetry between the company's lease commitments and its membership contracts. The leases were long-term, typically 10 to 15 years, and their termination provisions imposed financial penalties that made early exit prohibitively expensive. The membership contracts were short-term, typically month-to-month, and their termination provisions allowed members to exit with minimal notice. The company had committed to pay rent for decades. Its customers had committed to pay membership fees for months. That asymmetry was not a design flaw in WeWork's operating model. It was the operating model. The company's competitive advantage was the flexibility it offered members. And flexibility is the product of short-term contracts. The short-term contracts were the liability as well as the product. The specific covenant failure that the pandemic of 2020 exposed was the collapse of the assumption that the membership revenue would be sufficient to cover the lease obligations under any market conditions that the company was likely to encounter during the term of the leases it had signed. The pandemic reduced WeWork's occupancy rates to levels that the company's financial model had not treated as a realistic planning scenario, producing a revenue shortfall against the lease obligations that the company's liquidity reserves were insufficient to absorb, and that the SoftBank capital infusions of the post-IPO withdrawal period were insufficient to bridge on a permanent basis. At what point does a business model's competitive advantage become its primary financial vulnerability? Leave your analysis in the comments below. The valuation methodology that SoftBank's Vision Fund applied to WeWork in January 2019 was not a conventional real estate company valuation. Discounted cash flow analysis of lease income net of operating costs applied at a capitalization rate reflecting the risk of the underlying office market. It was a technology company valuation, a revenue multiple applied to the company's top-line membership revenue on the premise that WeWork was a technology platform whose network effects, data advantages, and scalability justified the premium multiples that software companies commanded rather than the discount multiples that commercial real estate operators received. That reclassification of a real estate operator as a technology company was the appraisal error at the center of the WeWork case, and it is the most specifically documented instance in this channel's archive of a valuation methodology applied to the wrong asset category. WeWork's revenue was generated by the spread between long-term lease costs and short-term membership fees. That spread is a real estate margin, not a software margin. Real estate margins are cyclical, location-dependent, and sensitive to occupancy rates and market rental conditions in ways that software margins are not. The application of software valuation multiples to a real estate margin produced a valuation of $47 billion for a company whose underlying economics, valued as a real estate operator, would have justified a fraction of that figure. The S-1 registration statement that WeWork filed for its planned 2019 IPO was the document in which the technology valuation methodology was most explicitly applied and most explicitly challenged. The S-1 introduced the concept of community-adjusted EBITDA, a non-standard financial metric that excluded from the company's operating losses the lease costs, the building depreciation, and the marketing expenses that the company's growth had required, producing a profitability figure that no conventional accounting standard would have recognized as a measure of financial performance. The public market's reception of the S-1 was the moment at which the technology valuation methodology collided with the real estate reality. Institutional investors and their advisors declined to participate in an IPO priced on the basis of a metric that excluded the company's largest and most durable cost category. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. Adam Neumann's management of WeWork between its founding in 2010 and his resignation as chief executive in September 2019 produced a forensic record of institutional behavior that combines elements documented in multiple previous case files with the specific characteristic that this channel has not previously examined: the deliberate construction of a corporate mythology designed to obscure the real estate economics of the business from the investors whose capital funded its expansion. The mythology described WeWork as a technology company transforming the future of work, as a community platform connecting entrepreneurs and creative professionals, and as a movement whose mission was to elevate the world's consciousness. The economics described a company signing long-term office leases and subletting the space at short-term rates, generating a spread whose sustainability under stress conditions had not been demonstrated at any scale before the company had committed to the lease portfolio that its expansion required. The denial architecture in the WeWork case is unique in this channel's archive because it was not the denial of information available to the ownership about its own assets' performance. It was the systematic presentation of a business that existed in one economic category, real estate arbitrage, as a business that belonged in a different and more highly valued economic category, technology platform. That presentation was successful with SoftBank, which valued the company at $47 billion on the basis of technology multiples applied to real estate margins. It was unsuccessful, with the public markets, which declined to participate in an IPO priced on that basis, triggering the valuation collapse that the bankruptcy proceeding eventually concluded. The resignation of Adam Neumann in September 2019 and the withdrawal of the IPO in October 2019 produced the timeline that the Chapter 11 filing concluded 4 years later. SoftBank's subsequent investments in the company, which totaled approximately $18.5 billion across all its commitments, were insufficient to bridge the gap between the company's lease obligations and the revenue its membership business generated under the market conditions that the pandemic produced. The $47 billion valuation that SoftBank had assigned in January 2019 declined to approximately $45 million by the time of the bankruptcy filing, a ratio of peak to trough of approximately 1,000 to 1. WeWork's bankruptcy filing produced a restructuring process that required the company to negotiate the termination or restructuring of lease commitments across hundreds of locations in dozens of markets simultaneously, a process whose complexity and scale had no precedent in commercial real estate restructuring history. The company's ability to exit the leases that were no longer commercially viable required the cooperation of landlords whose own financial positions varied enormously across the portfolio, from institutional investors with capital buffers sufficient to absorb lease terminations to smaller building owners whose debt service obligations depended on the WeWork lease payments that the bankruptcy was interrupting. The restructured WeWork that emerged from the bankruptcy proceeding in 2024 was a smaller company with a reduced lease portfolio, a recapitalized balance sheet, and a business model that its new management described as more disciplined than the expansion-era model that had generated the peak valuation and the peak lease obligations simultaneously. The company continued to operate flexible office spaces under the WeWork brand in the locations that the restructuring had determined were commercially viable. What the WeWork case reveals in the context of this channel's 23-case archive is the specific risk of a valuation methodology that systematically misclassifies the economic category of the business it is pricing. Every previous case file has documented a capital structure that was too large for the cash flows the underlying asset could generate. The WeWork case documents a capital structure that was too large for the cash flows the underlying business could generate, and that was made possible by a valuation methodology that categorized those cash flows as technology revenue rather than real estate revenue, assigning technology multiples to a margin profile that real estate economics had always governed. The office spaces are still there. The leases that survived the restructuring are still being paid. The members who use WeWork's flexible offices on a month-to-month basis are still signing up and canceling with the freedom that the business model was designed to provide. The asymmetry between the long-term commitments WeWork made to landlords and the short-term commitments members made to WeWork has not been resolved. It has been reduced. The model that produced a $47 billion valuation and a bankruptcy filing is operating at smaller scale with less debt. The fundamental tension remains. If this case file changed how you evaluate the relationship between business model classification and valuation methodology in technology-era real estate companies, subscribe to this channel because the next case examines a building whose valuation was never inflated by technology multiples and that still managed to produce one of the largest real estate defaults in American history. And in the comments, given WeWork's documented lease portfolio asymmetry between long-term commitments to landlords and short-term commitments from members, what specific covenant structure in WeWork's lease agreements would have limited the company's exposure to the revenue collapse that the pandemic produced?